This candlestick chart isolates spot gold's price action from early 2026. This terminal bearish engulfing candle marks the absolute peak, hitting $5,602.89. Viewed against historical flat lines of previous decades, this deviation completely breaks from traditional market behavior. Retail speculation lacks the depth to move the needle at this scale. This required coordinated movements of sovereign and institutional capital. By early 2026, official global gold holdings reached a total value of $3.909 trillion. To see the significance of that figure, we have to look at foreign official holdings of U.S. Treasury securities. They currently sit at $3.920 trillion, effectively parity with the world's gold reserves. Global central banks have mathematically pushed the international reserve system to a tipping point, ending the absolute hegemony of the fiat dollar. The Midas Shock represents the visible fracture point of three deepening systemic failures. This convergence is driven by a domestic institutional breakdown, a fiscal debt trap, and a physical supply chain blockade. When these three structural pressures fractured the market simultaneously, traditional commodity and bond pricing models lacked the capacity to absorb the impact. The severe volatility in the physical gold vault and the crisis in the energy market share the same structural origin. Identifying how these three pillars interact is the only way to establish the factual floor for global asset valuations moving forward. In early 2026, institutional trust in the United States was already under significant strain before the first market panic began. The catalyst was a Justice Department criminal probe in $2.5 billion in cost overruns regarding the renovation of the Federal Reserve's headquarters. Because the Senate stalled the confirmation of Kevin Warsh, the probe into Jerome Powell created an absolute leadership vacuum at the world's most powerful central bank. This line graph of the DXY shows the immediate fallout. The US dollar index lost 4% of its value in just 48 hours following the DOJ announcement. Investors immediately applied a governance premium to gold, seeking a neutral asset free from the legal and political entanglements paralyzing US leadership. This triggered a historic short squeeze in the COMEX and LBMA paper markets, forcing major commercial banks to scramble for physical bullion to cover positions. When the central bank of the world's reserve currency faces criminal scrutiny, capital abandons paper promises in favor of physical delivery. The institutional crisis only ignited because the US balance sheet was already suffering from chronic structural weakness. The One Big Beautiful Bill Act, or OBBBA, was designed to offset tariff impacts, but its actual consumer stimulus didn't arrive until early 2026. This $285 billion injection of tax refunds and business credits hit the economy at the exact moment the Federal Reserve ended quantitative tightening. This area chart projects the resulting impact on the US deficit over the next decade. The total deficit increase is estimated at $4.133 trillion. The IMF warns that this trajectory leads to US debt exceeding 140% of GDP by 2031, creating a massive refinancing risk. This level of fiscal saturation forces international bond buyers to view long-term US Treasuries as mathematically unstable. The weaponization of the dollar through sanctions has forced the Global South to find reserve alternatives that cannot be frozen or seized. BRICS Plus nations have adopted a golden shield strategy, shifting their balance sheets towards physical gold to insulate themselves from US financial policy. This horizontal bar chart ranks the primary drivers of gold demand. China has executed 16 consecutive months of purchases, while Poland added 20 tons in February alone. This physical accumulation coincides with a drop in the dollar's share of global reserves, from 71% in 1999 to just 56% today. Central banks are structurally de-dollarizing to survive an environment defined by US fiscal dominance. The monetary crisis met a physical accelerant in early 2026 with the closure of the Strait of Hormuz. While oil reaching $126 captured the headlines, the true systemic threat was the disruption of a multi-commodity industrial corridor. This supply chain map reveals the Gulf's role as a central hub for energy, chemicals, and metals. The blockade severed all three nodes simultaneously. With Qatar's LNG facilities targeted, 33% of global helium went offline, severing supply for US semiconductor manufacturers. As the silicon temperature spikes, the microscopic architecture of the wafer fractures, instantly halting the production of critical AI components. The blockade also stranded 46% of the world's seaborne urea. These bags of fertilizer represent a physical input that agricultural markets can no longer access. Without nitrogen-based fertilizers, farmers must shift to soybeans, ensuring a massive corn shortage and a secondary wave of food inflation. A localized naval conflict managed to cripple both the compute velocity of Silicon Valley and the yields of global agriculture. By April 2026, the immediate panic has cooled, and gold has retreated to the $4,600 range. This technical price chart shows the current distribution pattern. The candles have dropped below both the 20-day and 50-day moving averages, indicating a temporary shift in momentum. Despite this pullback, the structural floor for gold has been raised by 50% in a single year. The reality of high energy prices and supply chain destruction has moved the economy into a state of stagflation light. Natural demand destruction at $100 oil will suppress a 1970s-style spiral, but corporate profit margins will continue to contract under the pressure. The Powell Probe, the OBBBA debt trap, and the Hormuz blockade converge to overwrite the existing rules of global capital. Global reserves have crossed the parity threshold. A digital interface glitches and dissolves, exposing a solid core of gold bullion as the underlying foundation of the market. Uncontested dollar hegemony and infinite debt absorption have reached their mathematical limit. The Midas Shock marks the moment the global economy moved past paper promises to re-anchor in physical reality.